When London's silver market goes quiet, well, that silence is not normal. It's a warning. Right now, while your screen shows a calm London spot price, the real battlefield is 8 time zones away. On December 24th, the Shanghai Gold Exchange closed physical silver at roughly $78.49 an ounce, with premiums blasting more than $8 above Western paper prices. That is not a market. That is a siren. And then, just days later, COMEX silver dropped 11% in a single session after the CME hiked margins on the March contract by $3,000. Retail was told, relax, it's just profit-taking, just low volume. No. When the most important pricing hubs on Earth start gapping, starving, and seizing, you are not looking at normal volatility. You're looking at system stress. Let me translate the silence in London into plain language. The LBMA vaults in London once held over 35,000 tons of silver at the COVID peak. By July 2025, that hoard had been drained to just over 24,000 tons, almost a 50% collapse in visible inventory, before a small bounce toward 27,000 tons in November. At the same time, COMEX stocks have been quietly bleeding out, with combined registered and eligible inventories down around 1,525 tons in just a few weeks after October 10th. This is not a healthy reservoir. It's a reservoir with cracks running through the dam. Here's the disconnect. If London really is quiet, you should be seeing warehouses overflowing, spreads narrowing, and Shanghai trading at a discount. Instead, you have record or near-record prices above $80 an ounce, an $8 premium in Asia, and multi-year lows in above-ground inventories from London to Shanghai. The price on your screen is a lagging indicator. The atoms in the vault are the truth. Think of the global silver system as a high-pressure hydraulic line in an aircraft. Under normal conditions, fluid flows smoothly from London to New York to Shanghai. When London goes quiet, it's not that the pump has stopped. It's that the valves have been slammed shut. Pressure builds on the far side of the system, in this case, Shanghai and physical dealers, while the gauges in the cockpit still pretend everything is fine. That is exactly how you get catastrophic failure. Sudden, nonlinear, and impossible, right up until the instant it happens. Now layer on the physics. Silver is not a story stock. It's an industrial organ. The solar industry alone is now eating close to a third of annual mine supply, locking metal into solar coffins for 30 years at a time. Electric vehicles, data centers, military electronics, they do not care about your sentiment. They care about conductivity, thermal limits, and failure rates. Copper burns, aluminum fries. Once you push voltages and power density into the ranges we're building for AI and electrification, silver stops being an option and starts being a physical requirement. That's not economics, that's engineering. So while commentators on television say, silver had a big year, maybe it pulled forward some returns, the physics is telling you something very different. Every rack of servers, every new solar farm, every EV charging corridor is quietly bioaccumulating silver into the infrastructure of the next 30 years. Those atoms do not come back. They do not take profits. They disappear from the liquid system forever. So now step into the risk room in London on a quiet day. The clearing statistics tell you that in a normal month, London moves the equivalent of hundreds of millions of ounces of silver through its pipes every single day. That is the lifeblood of the over-the-counter market. But after a week of Shanghai premiums, an 11% COMEX air pocket, and headlines screaming about export bans, the phones are not ringing. Dealers pull bids, spreads widen, quotes time out. The screen looks calm because no one wants to be the next counterparty. Silence is not comfort. Silence is counterparty risk. You can almost hear the conversations. The junior trader on Holiday Skeleton Crew looks at the books and whispers, "If Shanghai is $8 over our benchmark, why are we still short?" The risk manager is staring at a VAR model that has never seen $80 silver. Meanwhile, overnight, a single exporter changes terms, or a sovereign wealth fund asks for physical delivery instead of rolling paper. The whole delicate chain, OTC swaps, unallocated accounts, just trust us, pool accounts, starts to look like a hydraulic line with vapor pockets. One hard maneuver, and the controls slam. And then the geopolitical hammer drops. China already controls most of the refined silver flow on this planet. As 2025 ends, they're preparing to tighten exports further, right as Western politicians float 25 to 50% tariffs on so-called strategic metals. You've just converted a strained industrial commodity into a weaponized input in an economic war. At the same time, analysts are talking about an annual deficit approaching 800 million ounces when you combine industrial demand, investment flows, and shrinking mine supply. That is not a market you casually short. That is a market you pray does not gap above your head. In that environment, what does quiet London really mean? It means the Western benchmark has become too dangerous to trust as a true barometer. It means the people who actually move size are trying to reduce their visible footprint. They do not want to show size bids. They do not want to advertise where the real demand is. Because once the herd realizes that the spot price is a lie, the stampede out of paper promises and into atoms will not be orderly. Here's the mathematical inevitability that no one on CNBC wants to say aloud. If above-ground inventories keep falling, industrial demand stays inelastic, and the East continues to pay a structural premium for real metal, then either Western paper prices teleport higher or the system breaks and physical decouples completely. There is no third path where everyone is fine and the spreadsheet wins. So what do you do as a prepared investor when London goes quiet? First, you stop mistaking silence for safety. A flat line on the tape can be just as deadly as a spike when the underlying system is stressed. Second, you stop thinking in tickers and start thinking in atoms. You decide how much of your future you are willing to outsource to counterparty risk and how much you want anchored in metal that does not depend on anyone's promise. I'm not here to tell you to chase candles or leverage up on the next short squeeze. Leverage is how the herd dies. I'm here to tell you that the disconnect you're seeing between a quiet London screen and a screaming Shanghai premium is your advance notice. It is the market whispering, this structure is not designed for what is coming. If you understand that, you are already ahead of 99% of the so-called smart money. You see the hydraulic lock building in the system. You see the tectonic plates of East and West grinding against each other under the pricing surface. You understand that in a world of weaponized trade and digital currencies, owning atoms instead of paper is not a trade, it's survival. You are the prepared investor. You already know the spot price is a lie. You already know the silence in London is not low volume. It's the sound of counterparties backing away from the blast radius. Hold the line. Stay with the material truth, and do not expect the herd to understand what just happened until it's priced in.